Ladies and gentlemen, good day and welcome to Aarti Industries Q4 FY25 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Nishit Solanki from CDR India. Thank you, and over to you, sir.
Thank you. Good evening, everyone, and thank you for joining us on Aarti Industries Q4 and FY25 earnings conference call. Today, we are joined by senior members of the management team, including Mr. Suyog Kotecha, Executive Director and Chief Executive Officer, and Mr. Chetan Gandhi, Chief Financial Officer. We will commence the call with opening thoughts from Mr. Kotecha on the Q4 and FY25 performance overview and outlook, post which we shall open the forum for Q&A, where the management will be addressing queries of the participants. Just to share a standard disclaimer, certain statements that may be made in today's call may be forward-looking in nature, and the disclaimer to this effect has been included in the results presentation that has been shared earlier and uploaded on stock exchange websites. I would now like to invite Mr. Kotecha to share his perspectives. Thank you, and over to you, sir.
Thank you, Nishit. Good evening, everyone, and thank you for joining us today. Apologies for joining this call 15 minutes late. Let me begin by acknowledging FY26 has started on a major note, coupled with new uncertainties such as US tariffs. The overall external environment remains volatile, marked by increasing global uncertainties stemming from geopolitical events and evolving trade dynamics, requiring us to remain agile and adaptable in our strategic planning. Having said so, we're seeing encouraging signs of stabilization in demand across several end-user industries and underlying volume growth across our businesses. The growth is being supported by our strategic initiatives to diversify our product portfolio, expand our geographical reach, and strengthen our customer relationships. Overall, we are well poised to navigate the current volatility and capitalize on the future growth opportunities within the evolving chemical landscape. I'm pleased to share that we ended the challenging year with a positive note. We clocked in total revenue of rupees 8,046 crores, posting a growth of about 15%, while EBITDA grew by about 3% to rupees 1,016 crores on a consolidated basis. Commercialization of our various projects and higher interest costs in FY25 did increase the depreciation and finance cost component, resulting in PAT of 331 crores. Speaking now about our Q4 performance, it has been steady on a sequential basis. We clocked in revenues of rupees 2,214 crores, marking a 9% quarter-on-quarter growth, largely driven by volume recovery across all end applications. EBITDA for the quarter came in at rupees 266 crores, reflecting a 13% sequential improvement. Likewise, PAT increased to rupees 96 crores, mostly driven by better cost efficiencies achieved through higher volumes. Considering the annual performance, the board has recommended a final dividend of rupees 1 per share for FY25. Speaking to specific applications, I think volumes for energy application grew 21% quarter-on-quarter, linked to our strategy of diversifying and widening customer base and geographical spread as well. On the other hand, the base business has also shown good volume recovery across chains such as nitrotoluene, nitrochlorobenzenes, and ethylation-based products, also linked by our new capacity additions and improving demand landscape. These segments have also contributed sequential uptick in overall performance and will now remain a focus area moving forward. Volumes in this segment grew by 14% quarter-on-quarter basis. Even an agrochemical inventory level seems to have stabilized now. The demand for other end-use applications like dyes, pigments, polymer additives also remains positive. We are anticipating this volumes to continue this growth path as we move forward into the FY26 timeframe. Earlier this year, we signed 2 renewable energy power purchase agreements for solar and hybrid power with CleanMax and Prozil. These agreements are also on track, with one of them expected to start delivering within this calendar year, and the second one expected to begin by end FY26 or early FY27. Upon commencement, this will lower our operational costs and provide sustainability benefits by facilitating also a transition to cleaner, more resilient energy landscape. Sustainability continues to be a key driver and focus area for future roadmap. I'm happy to inform that AIL has been elevated to the CDP leadership band for its outstanding performance in climate change and water security. Our ESG score also improved significantly to 62 in S&P Global DJSI Index, Dow Jones Sustainability Index, positioning us in top decile of global chemical companies. We have also maintained gold medal in the EcoVadis CSR assessment for 2025, marking our 4th consecutive year of excellence. Our score has also improved to 78, up from 72 last year. This places us in top 5% of the companies assessed by EcoVadis. AIL has also been granted approval by Indian Chemical Council to use Responsible Care logo now for a 3-year period from April 25 to March 28. All of these accomplishments reflect our unwavering commitment to the responsible care principles and highlight our dedication to sustainable practices and ethical conduct across all aspects of our operations. In FY25, several cost optimization initiatives, both variable and fixed, were also successfully completed, and we plan to achieve similar targets in FY26. The key achievements include successful implementations of back pressure turbine projects to improve steam efficiency, scaling up our power generation through the first phase of hybrid power project, which also helped us reduce carbon footprint and generate cost savings. Yield improvements across key products value chains such as ammonolysis, nitrochlorobenzene, halex, and hydrogenation products. Additionally, we continue to take steps to optimize our fixed costs, and we are progressing quite well on that dimension. On CapEx front for FY25, we stood at about rupees 1,372 crores, in line with our expectations. Our large project initiatives at Zone 4 are being executed in phased manner, and with the commissioning schedule to progress in a staggered manner throughout FY26. Our newly operational pilot plant at Zone 4 has already commenced commercial operations. It will play a vital role in driving new product development, fostering innovation, and supporting diversification of our offerings moving forward. Based on our current plan, we expect CapEx for FY26 to be in the range of 950 to 1,000 crores. To sum up, while the external environment remains volatile, we are encouraged by our business resilience, agile cost control measures, and clear path to capital discipline. We are entering FY26 with a strong execution pipeline, healthier balance sheet, and a sharp focus on delivering sustainable and volume-led growth. Thank you, and I now welcome any questions from the participants.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. First question is from the line of Kumar Saumya from Ambit Capital. Please go ahead.
Hi, sir. Good evening. My question is on the volume growth. So if you could give us indication on the year-on-year volume growth in FY25 as well as the fourth quarter.
So I think on a fourth quarter, on a quarter-on-quarter basis, non-energy business grew roughly by 40-odd%, and the energy business grew by almost 21%. I think that energy business volume growth was also linked to, as we explained in the last call, one of the shipment had got pushed out from Q3 to Q4. So that's the range of volume growth numbers. If you look at year-on-year numbers, FY24 versus FY25, we are roughly at around 17% growth at overall portfolio level.
And we expect to continue this growth momentum, at least in the volume side.
Look, I think if you look at the capacity utilization numbers that we've given, value chain by value chain, clearly shows that we have a significant upside to drive volume growth based on existing asset footprint. And we remain very aggressive in the market to capture growth as well as increasing market share to ensure we drive up our capacity utilization level.
Yes, sir. Thank you. I'll come back in the question.
Thank you. Next question is from the line of Aditya Khetan from Swift Institutional Equities. Please go ahead.
Thank you, sir, for the opportunity. I have a couple of questions. Sir, onto the agrochemical business, we had witnessed that volumes had reported an uptick, but pricing still remain under pressure. Any specific reason, sir, for this? Because the destocking cycle has ended roughly around 9 to 10 months back. So why are the prices still weak?
I think we covered this in some of the earlier conversation. I think overall our perspective is the inventory destocking story got done some time back. I think there's a genuine demand-supply imbalance issue for the agrochemical intermediates and downstream technicals. We are seeing volume recovery for sure, but given the amount of overcapacity that exists in China, that incremental volume growth is also served the marginal pricing, and that's where we are not seeing uptick on pricing/margins at this stage. Going forward, especially with the US tariffs announcements, there are some movements happening in the overall agrochemical value chains, and we expect, at least from a downstream product flowing to US point of view, there should be positive traction. And in that context, the requirement of intermediate for our domestic customers is expected to go up.
And sir, so they should benefit after the tariff imposition, or you think the demand supply dynamics will automatically adjust and we can see improvement so from the very first day?
No, I think it will take its own time to adjust. What is very clear is that the volume and the demand growth is there. I think pricing and margin is a bit of a complex question to answer because there are second, third order impacts. Right? If the downstream exports of Chinese technicals and formulations gets impacted, I think they will also have a tendency of dumping the intermediate product portfolio in the remaining part of the world. And in that context, how the country and the market we protect ourselves from that dumping will also determine to some extent our margin profiles for those intermediates. So I think the impact coming out from US tariffs, especially on the agrochemical sector, I think the second, third order level of impact is yet to become visible. And our sense is it will take a few months to play out.
Got it. Sir, when we say that the agrochemicals and pharmaceuticals volumes are witnessing an uptick, even the dye segment also, so why the dichlorobenzene volumes in second half is relatively weak compared to first half?
So dichlorobenzene, the end application is actually polymer, right? It's I think PDCB specifically goes into polymer segment, mostly into PPS, which is used into automotive kind of applications, and that segment has been under pressure from a demand point of view. So I think in the first half we were actually expecting much more inventory correction by some of our customers in US and Japan, and that's what impacted DCB chain volumes. But again, even in that case, we have seen some level of inflow coming in, especially from the US customers, to advance their shipments in the first quarters to have certainty around the tariff impact. So we'll see slightly different behavior over the next 3 months. But in general, the DCB volume question that you asked was more linked to polymer end application, and it was not linked to the other two applications.
Got it, sir. Just one last question. Sir, this quarter, FedEx, which is the Saudi chemical giant, so they have also reported losses at the bottom line. And sir, one of our long-term contract is linked with FedEx. So does this change or alter any of the offtake agreements with them?
No, there is no impact on our arrangement at this point.
Okay, got it. Thank you.
Thank you. Next question is from the line of Vivek Rajamani from Morgan Stanley. Please proceed.
Hi, sir. Thank you so much for the presentation and congratulations on a good set of numbers. 2 questions from me. Firstly, on the MMA side, I think you mentioned in your comments that you have made progress on expanding the customer base as well as the geographic base. Could you just talk a bit more about what kind of customers these are and what kind of impact they could have in terms of the pricing, as they ramp up? That's the first question.
So I think the M&A effort, as we mentioned earlier, I think we obviously trying to diversify consumption, which was more concentrated mostly towards Middle East. Now we are seeing increasing supplies going to US, some of the high-speed supplies going into Europe, as well as the Indian volume is also looking up. So in that context, the broader geography diversification is playing out. At this point in time, we remain focused on market development, right? And the objective is that we have a significant capacity to produce this particular product. And we remain focused on developing the market and ensuring there is a much wider customer base which has used the product, understood the value proposition, and is able to consume it in sort of larger quantities in their end applications. From a pricing and margin point of view, it's relatively linked to raw material in most cases, and I think most of the global markets do understand it to a great extent now. Aniline is a key raw material which drives ultimately the MMA price. At the same time, there is also impact of the downstream end markets, right? As we've explained before, there is ultimately the viability of the product to the end customer is linked to the gasoline naphtha economics and gasoline crude economics. So combination of the two is what determines the pricing. But right now our focus remains on developing the market for the higher volumes.
Sure, sir. Thank you so much for that. The second question I had was more from the broader customer base. Just wanted to get your thoughts, with everything that's happened recently in the past few months. How are the customer conversations generally evolving into the remainder of 25 and 26? Is there more uncertainty? Is there, a shift towards probably more short-term contracts? Could you just give us a sense of how the customer is thinking about everything that's been evolving? Thank you.
So I think if you're asking specifically about MMA, then I think, as I said, we are in a development phase. So I think every conversation is sort of discovery of a new client, taking them through the entire, sampling, qualification, trial, test, sort of try and test kind of mode. And that journey continues.
Sorry. No, I was actually talking non-MMA. I think you covered MMA pretty well.
On non-MMA,
more on the ag chem,
on non-MMA, frankly, the volume growth still looks very strong. I think, yes, the recent events do pose a challenge where some of the customers start going into sort of holding decision kind of mode, right? Because there's so much uncertainty around what's going to happen to tariff, what's going to happen to end market growth, will there be recessionary pressures, will growth rates come down? I think in that context, we saw there was a phase in which there is kind of a holding pattern where people start pushing out key decisions. But over the last few weeks, we have also started seeing people coming back, right, and sort of moving on with respect to regular business. In general, we are anticipating, the tariff issues to settle down over the course of next 2 to 4 months, and that will definitely bring much more clarity in terms of how the final trade flow will settle.
Sure, sir. I'll rejoin the queue. All the very best.
Thank you. Next question is from the line of Abhijit Akelia from Kotak Securities. Please go ahead.
Yeah. Good evening, and thanks for taking my questions. So first on the outlook for fiscal 26, would it be possible to share any, revenue or EBITDA kind of targets you have for the year? I know there's a 3-year target out there, but anything you would like to share for fiscal 26, please?
No, I think Abhijit, we are not talking about a specific yearly guidance. We mentioned that last time, right? We've set out a strategy for the 3-year, and I think the only thing I can confirm is we remain on track to deliver that 3-year numbers. Of course, not all of it is back-ended. I think we've also given clarity on initiatives that will lead us to that range, right? And the initiatives are a combination of cost, operating leverage-related ramp-ups, and then new CapEx-led growth. And in this time's presentations, we've also talked about, at least given some indication of which of these initiatives are completed, which of these initiatives are sort of ongoing and advanced stages of completion. So in that context, what we can say is that we continue to remain optimistic about volume-led growth for the coming financial year. From a 3-year standpoint, we are not changing the guidance that we had given earlier, and we feel confident and remain on track to achieve that.
Okay. Second, just on the tariff impact, are most of the products you export to the US exempt from the tariffs? And if so, what sort of implications, if any, do you see for your business in the context of this whole tariff developments?
So I think if you want one-line summary, then I can say that the overall US tariff impact on AIL is a bit mixed, right? And because it is complex, we have a wide variety of the product portfolio, and different products have different implications because some products are part of Annexure 2, some products are not part of Annexure 2. In general, the products where we are directly competing against China, and if they are not exempted, if they are not part of Annexure 2, then in that context, of course, we have a positive tailwind. And likes of, for example, NPDA is one of the products in PDA chain, where in the near term we are seeing positive demand traction because it's not part of exemption and the competition was from China, so there is a clear-cut advantage. While there are some products which are part of exemptions, but even though they are part of exemptions, I think there is a tendency generally coming out from the market to see if they can source better volumes from India, provided we are able to meet the pricing expectations. There's a second category of products, and there are a lot of products in that category, especially in the sort of agrochemical science and life sciences. And the third category of the product is like, for example, MMA, where we are not really, frankly, competing head-on with any particular manufacturer, but it's more of a market development effort that we are doing. In that context, of course, tariffs have a negative impact because they straight away add cost to the product for the final customer, and the economic viability does get a little bit compromised because of increased costs. So I think 3 types of scenarios I described, all of them have different types of impact. And we are not even talking about second, third order impact, right? Right now we're talking about a direct product level impact, but in the overall 3 to 4 months time frame, the second and third order impact will also start to come through in terms of what happens to end use sector growth, what happens to US demand, what happens to the extra volume that gets freed up from China. So all of that is expected to play out over the course of next few months and quarters. At current level, based on our best judgment, we can say it's a mixed impact on AIL. Certain products are definitely seeing positive traction, whereas for certain products, we're trying to adjust the pricing to ensure that the tariff impact is absorbed by the both sides in a fair manner.
I think that's a really helpful color, actually. Thank you for that. And just one last thing for me before I rejoin the queue. Just on the CapEx outlook for fiscal 26, the 1,000 crore approx number, what projects specifically is that going into, the bulk of it? And from a revenue growth standpoint for fiscal 26, is it coming primarily from better utilization of the existing product capacities, or are there any significant contributions from the newer projects you are commissioning? Say, for example, Zone 4 engine that's getting commissioned. Thank you.
Yeah. So I think bulk of the capex spend that we have committed right now is going to Zone 4. I think we will complete the Zone 4 capex, by and large, within this financial year, and a significant part of that number is sort of reserved for that. In terms of volume growth for this year, large part of it will come from existing assets which are already commissioned. Zone 4 staggered commissioning will happen throughout, let's say, quarter 3, quarter 4 of this financial year. Especially the multipurpose plant, the calcium chloride plant is expected to start up in Q3. But we don't think there will be a significant addition to volume growth based on this. This will take time to stabilize, ramp up during this financial year. And the volume growth from all of these assets will actually start to get reflected from the next financial year. So yes, this year, I think we are pushing for volume growth from the existing assets which are already stabilized and ramped up.
Understood. Thanks a lot, and all the best.
Thank you. Next question is from the line of Arun Prasad from Avendus Spark. Please go ahead.
Good evening. Thanks for the opportunity. So my first question is on the impact of the current crude prices on the MMA. So I understand that our margin, probably our realization will also go down as the crude price come down. But what will happen to the spreads, especially the gasoline naphtha spread? Will it historically has it come down, and that will also have impact on the MMA margins that we will be realizing?
So Arun, the crude prices has corrected very sharply, and at the absolute level, gasoline and naphtha have also corrected. The gasoline naphtha spread has actually widened a bit if you look at the March numbers or April number for that matter. And as I described, I think absolute prices are of importance, but at the same time, the delta is also of larger importance because that's what determines the viability of the product. So that's first. Second, as the absolute prices are coming on the crude gasoline side, even the raw material is also coming down quite significantly. So that, though of course there will be a lag in terms of adjusting the raw material from an inventory valuation standpoint, because bulk of this raw material is imported from out of India. So usually there's a lag of 1.5 to 2 months to get the pricing adjusted from a raw material costing point of view. But there's also significant correction on that front. In that context, I think overall, we feel if the current gasoline naphtha differentials are maintained, then we are hoping to continue on the volume trajectory.
But directionally, the spread increase on the lower crude price, is it a short-term event, and it will revert to the mean over the medium term? Is it the right understanding?
Frankly, I would be totally honest, very difficult for us to forecast on gasoline naphtha spread, especially a different crude price environment. I think I have seen now forecasts from 3 different agencies in last 6 months, and none of them have panned out the way it was supposed to be. So what we remain focused on is to ensure that what's important for us at this point in time is that the product is available to more and more customers in the global market. And that's what we remain focused on. The current level of differentials is good enough for people to try out this product and sort of scale up the usage of this product. And third aspect is, we continue to optimize on our costs, right? Both raw material as well as operating costs, to ensure that we are able to offer better value proposition to our customers.
Right. Understood. Second question is on our EBITDA, 3-year EBITDA growth outlook that we have given. Out of the 3 buckets, one is cost optimization, and then volume ramp up, and then capex-led growth. Is it fair to assume that cost optimization that we will be realizing this year in FY26?
From an implementation point of view, bulk of it will be get done in FY26. From a EBITDA accrual of that saving initiative point of view, it will go into, I think the full accruals will happen into next, sort of not in this financial year, but the next financial year. Especially, the hybrid projects which are expected to contribute also significant value. They will start accruing to bottom line fully from start of FY27. So implementation-wise, yes. Accrual point of view, slightly delayed.
Even for the cost optimization bucket?
Yeah, especially the hybrid power part of it.
Okay, understood. So largely this 26 fiscal earnings growth will be led by the macro parameters.
Yeah. I think, as we said, we remain focused on driving up utilization of surplus capacity that we have in the existing field, and then continue to optimize the cost.
Understood. Thank you very much. All the best.
Thank you. Next question is from the line of Dikshant Gupta from Geojit PMS. Please go ahead.
Yes, good evening. So my question was, what exactly would be the reason for higher expense growth than the sales growth, even though the sales volume has grown a lot, but the number-wise, the expenses have grown a lot, but the sales number has not grown as much. So what would you attribute that to?
So there's an increase in global transactions or shipments. So the export numbers have been significantly higher. If I have to put the number out, 55% of revenue for the quarter is from exports as compared to the previous period where it was close to 48-50% kind of stuff. So that is resulted into increase in the freight cost.
And you are saying that after the cost optimization takes place, then the margins will improve and this profitability will go up.
Yeah, that is how it will pan out.
And with decreasing price, crude oil and petrochemical prices, do you see that the volume growth can offset the pricing pressures?
I think both, frankly, are a little bit delinked. I think for us, if you look at the reducing price environment, right? If you really want to sort of go a bit deeper into the analysis, what are the major raw materials that we consume? Right? We have benzene, we have nitric acid, we have aniline, right? And we have toluene to some extent. Out of which benzene and nitric acid, we practically operate on very, very limited inventory. We are talking about 1 to 5 days kind of inventory. So in that context, the pricing impact in our inventory is immediate, right? So our ability to manage that to our customer is very, very high. Versus aniline is where we import the raw material. So of course we have to maintain certain inventory, and then there is a 1.5 to 2 month lag in terms of reflecting the latest market pricing into our inventory valuation, which is where we have to manage the inventory valuations to some extent while ensuring that we give the best possible service to our customers. But so on a net basis, from a volume growth point of view, we manage our inventories and pricing in a way where we don't let that impact our volume growth, and that's been the philosophy for the operations.
Okay, thank you. That is all from my side.
Thank you. Next question is from the line of Harsh Shah from HSBC Asset Management. Please go ahead.
Hi, just one question. In your balance sheet, your data days have reduced on a YY basis. Inventory days more or less is the same, but your payable days have more than doubled. What is the reason for that? Because if you look at from a cash flow perspective, also apart from operations, increase in data days has led to a significant cash flow accretion for you in this year. So yeah, what is the reason for that?
Yeah, it's more of some of the imports of raw materials such as aniline and everything comes at a longer credit, which is where the numbers have gone up. And also the aniline consumption over the last 12 months have been significantly higher. If you look at the volume data of different products, MMA, the volume numbers across 2 years have increased by more than 38, close to 38% or so. So that has resulted in higher consumption of aniline, higher import of aniline, which comes at a longer credit.
Okay. And entering FY26, will this remain like this or will this reduce? Because this is again also one of the reasons why your net debt has remained range bound.
It should remain like this, I guess. With increasing the volumes, probably there could be a bit of an uptick every opportunity available. But broadly, I will say between here and a bit of increasing those numbers will be somewhere midway.
So as a company basis, in the whole of FY26, or you can also guide for H1 if the outlook is still not there, what is the overall working capital days that you are looking at?
I should be somewhere between 70 to 80 days kind of stuff. We will have to work out some numbers, but yeah, it should be in that.
Because ideally that will lead to reduction in payable days, which will again shoot up your debt position. Your cash may not be able to handle that much of reduction in payables. Yeah.
No, I think if you look at the absolute number of working capital, I think we feel pretty comfortable with where we are.
Yeah.
And I think without increasing the absolute rupees crores in working capital, we should be able to handle the FY26 volume-led growth is our current sense.
Okay. Sorry, just last question from my end is with respect to net debt. You closed the year somewhere around 3,500 crore. For FY26, how will this number look like, figuratively or directional?
So directionally, I guess we would have peaked out. We expect the number to be lower. We are expecting some unlocking of cash flow from working capital as well. So plus the CapEx intensity is also going down. So directionally, I expect the number to be lower by maybe 200-300 crores kind of stuff.
Okay. That's it from my side here. Thank you, and all the best.
Thank you. Next question is from the line of Vishesh Thoka from Nuvama. Please proceed.
Hi. Good evening, sir. Aarti here from Nuvama. Sir, I wanted to get a better sense of growth prospects in FY26, given that we have given our utilization levels. I think it's quite conceivable that PDA, nitrotoluene, and ethylation, these are the kind of low-hanging fruits here. What would be the utilization, for NCB and DCB, given that we are above 70%, even in hydrogenation? Where could we peak out? And if you could just give a directional sense of how do we see these three value chains of PDA, nitrotoluene, and ethylation in terms of any visibility that you can give with regards to volume growth in FY26?
Look, I think we'll talk about value chain specifically. So let me start with PDA, which has frankly been underperformer for last few years. If you go by the current latest trends, I think we expect significant uptick in utilization levels because of increasing demand in US given by tariff issues. So that chain should see higher level of utilization compared to last year. NCB, nitrochlorobenzene as a chain, given a couple of large customers are increasing their capacity. Bulk of the application there is pharma. And both large customers are increasing capacity. So through the year, we also expect the NCB capacity utilization to go up from the current levels. DCB, frankly, we expect, maybe we should be able to maintain the current level of utilization level. This is where we are, there's a mixed bag in terms of the downstream consumer demand of PPS, which is going into automotive, a little bit of pressure, and depending on how US and Japan plays out, there could be some impact on the demand of DCB chain. So broadly, maybe we are able to maintain the current utilization levels. And nitrotoluene and ethylation are linked to each other because NT provides raw material for the ethylation chain. That's where the life cycle, the life sciences and the agrochemical story comes into play. Right. We are expecting higher utilization compared to last year for this particular chain. But it is a ramp-up process because, we expanded capacity very recently. The full capacity actually got proven only in Q4 FY25. So it will take a bit of a time to ramp up the capacity utilization levels, but nonetheless, the number should be better than the last year.
Sure, sir. Got it. That's helpful. I just have another one on MMA. I was just reading some articles with regards to some new competition beefing up in China. I think there's a company named Jiangsu New Materials who has planned a 4 lakh ton capacity, almost double of our size. While I'm aware that the opportunity for developing this market is immense, but do we see this trend of either switching from MTB to MMA or developing this market even in other areas is becoming a trend, and would that be of any impact to us in the near to midterm?
No, I think competition will come, right? I think people do track us closely, and in that context, it is expected that competition will come up as and when we scale up certain products. But that's perfectly fine. If more people are trying to develop the market, it also works in industry's favor. We do have a certain unique advantage for this particular product. I think, of course, we have a head start in terms of supply chain capabilities that we have built over the course of the last 2 years that allows us to do some unique things which are not available to a lot of other players, including, I think, some of the freight components, especially if you're sending, bulk shipments to Middle East or Europe or US. I think we are slightly better positioned at this stage compared to competition. And in addition to that, I think we remain sort of in the market aggressively to expand more and more customer base. So Of course, we are expecting competition in the product, and people will ramp up capacities over the course of, we don't know, maybe a year, maybe 2. But at the same time, we feel the market is large enough to absorb the volumes, and we do build certain competitive advantages which allow us to, better capture the market share.
Sure, sir. That's great. Thank you, and all the best for the next year. Thanks.
Thank you. Next question is from the line of Surya Narayan Patra from PhillipCapital. Please proceed.
Yeah, thanks for the opportunity, sir. My first question is on, let's say, on the MMA. So since it is a new product area, and we have been seeing a kind of rapid expansion in terms of volume over the last few years. So given the kind of a new customer addition and all that, so how to see the progression and the growth in terms of volume for this product, let's say for FY26?
I think we've described what's our current capacity, and we've also said that over the course of next 2 years, we are targeting to utilize that capacity. And that's where I think we will remain focused. Whether we take 12 months, 18 months, 24 months to reach to a decent level of capacity utilization will be linked to the success of market development efforts. But that's the overall strategic direction, that the current capacity numbers, we should be able to develop market good enough to absorb that volume in a 2-year kind of time frame.
Okay. Overall, let's say that the overall growth for FY25, if you see, it is entirely led by the volume-led growth.
Yeah.
So, given the kind of new projects that we commissioned in the later part of the FY25, and hopefully and potentially the chlorotoluene, which is likely to also come in the second half of FY26, and also the likely ramp up in the MMA volumes given the new customer addition. So, going ahead for FY26, is it fair to believe that the volume-led growth, it would be a volume-led growth, and the volume-led growth would be better in FY26 compared to 25?
So right now, our base assumption, we are factoring in most of the growth led by volumes. We are not factoring a significant recovery in the margins because we don't see the demand-supply imbalances from China getting corrected soon. However, though that's correct at a macro level, I think from a near-term point of view, there are events which are difficult to predict, right? How the US tariff scenario will pan out, how the geopolitical uncertainty will pan out is difficult to predict at this stage. But from a management focus point of view, I think we remain focused on delivering the volume growth. Margin is a function of a lot of external factors as well. If there is opportunity, we'll capture it, right? But that's not a base assumption with which we are going into the financial year.
Okay, just even slightly more clarification. Let's say, is it fair to believe that the volume-led growth, what we are talking about for FY26, that would be higher than the FY25 growth, what we have seen, or not predictable at this moment?
I think difficult to comment. Look, I think, we don't want to start talking about sort of, quarter on quarter, the exact sort of volume growth. I think we have certain assets. We've been very transparent with respect to where we are on the capacity utilization for these assets. And in a 3-year plan, if you see bulk of the operating leverage-oriented initiatives, we are targeting to finish it in the first 2 years, right? And that's where we expect most of our assets, barring few where we have, let's say, costing issues, where we are not competitive with respect to the world-scale assets from other players, we should be able to reach respectable level of utilization levels within the first 2 years kind of time frame.
Okay. Sir, since it is the full year result that we are discussing, is it possible to just update about what is the kind of level of performance that we are having for the long-term contracts? So, whether we are in the expected lines or it is slightly below given the kind of demand situation that is prevailing currently, or how should we be thinking about the long-term contracts that is been doing so far for FY25, and what is the likely outlook for those contracts for FY26?
Yeah. Look, I think contractually speaking, I will take the simpler ones first. I think the 20-year purchase agreements that we have for nitric acid, continues to perform exactly as per contract. No issues on that front. The other project that we have, which is where sort of our profitability is ensured, right? It's polymer application with a global major. I think that continues to run very well. No changes on that front. And, there's another contract which we had with US major for a very advanced specialty polymer intermediate, which has started ramping up only last year. We are expecting that to do even better in the coming year, right? With the asset now stabilizing and sort of demand kind of picking up. I think those are the easier ones. I think rest of the contracts are sort of they're kind of a sort of supply contracts for some of the key intermediates. There individually, depending on the end market applications, there will be a variation, right? I think the contracts ensure that there's a relationship between the two parties where we have sort of privileged access to each other, and there are certain contractual terms in terms of volumes and pricing. But they do vary linked to market conditions, and that's how it is playing out at this point in time.
Okay. Sir, just one question for the Chetan sir. So, what is the export number for the quarter, sir?
The export number for the quarter was roughly 1240 crores.
Okay, 1240 crores. Okay, so there is a kind of mark improvement sequentially that we.
Yeah. So as Ayush said earlier, and it was shared in the last call, a couple of bulk shipments of exports which were expected to move out in Q3, end of Q3, which did move and which moved out in Q4. So that has also been one of the factors why some of this bit of this number is higher. But yeah, there's a significant improvement in export volumes as we witnessing.
Okay. And so if there would be a kind of a normalization in the export, then the other expenses are also likely to see a normalization going ahead, or how?
Yeah, because export has a higher component of freight, which is where you see the other expenses going up. If I have to specifically look at the fixed, it was actually has been lower on a sequential basis, or more like a lower to flattish kind of a situation. It's more of this freight and other component which is there.
Thank you. Next question is from the line of Siddharth Gadekar from Equirus. Please proceed.
Hi, sir. So first on the tax rate, how should we think about the tax rate for FY26?
We still have one more year of heavy CapEx cycle, which is where the IT depreciation is going to be high. So we'll continue to remain lower and subdued on the tax rate. I know this year we've been negative on the tax rate level. I expect it to be in somewhere close to mid-single digit in next year.
Okay. So secondly, on the trade payables, I was still not clear on your answer that trade payables have jumped by 600 plus crores this year. How should we think about this number going into FY26 and 27?
I believe there will be a potential uptick of maybe around 100 to 150 crores maybe 100 to 200 crores in next year, assuming the volumes continue to grow in the trajectory they are.
The trade payables will increase, you're saying, by another 100? Okay, got it. Thank you.
Thank you. Next question is from the line of Jay Bharat Trivedi from InCred AMC. Please go ahead.
Hello. Am I audible?
Yeah.
Yes, please go ahead.
Thank you for the opportunity. First question I have is with regards to the capex that we are doing, the 1,000 crore capex that we have estimated. How much of it would be maintenance capex and how much of it is in the nature of new chemistries or new products what we are getting into?
I guess the maintenance CapEx and some CapEx related to some of the initiatives which are there on the existing product should be in the range of 150-200 crores or so. Beyond that, everything will be for the new initiatives. The Zone 4 is going to be a bulk of that.
Okay, so 150 to 200 crores is the maintenance CapEx and rest is for new products, correct?
Yeah.
Okay, sir. And I was just quickly doing some numbers on the guidance which you have given for FY28. For the 1800 crore to 2200 crore EBITDA, will our PAT fall around 900 to 1000 crore in the 900 to 1000 crore range, or am I far off? I don't want an exact number, but am I in the same lines what your assumptions are? Or?
See, if I look at FY28, my depreciation, which is currently at around 430 odd crores, should be somewhere between 580, 600 or between 580 to 620 kind of crores. So that, let's assume 600 or 620 crores on depreciation. Interest, I'm not sure what's going to be the interest rate scenario, but let us assume a current number of around 250 to 70 odd crores. Then we will have around roughly 850 crores going out. So I would assume at 1800 crores, we will be somewhere between 900 to 1000 crores, at a PBT level. And at a 2200 crores, we will be somewhere between close to 1200, 1300 crores.
Okay. Thanks. Those were my questions. Yeah. Thank you so much and all the best, sir.
Thank you. Next question is from the line of Meet Vora from MK Global. Please proceed.
Yeah, thanks for taking my question. Just on this MMA side, so while we are seeing that in US market, it would add extra cost on the consumer, and there could be some impact because of absorbing this cost at their end. My understanding was that this is imported by blenders for re-exports, and thus tariff will not be applicable. So is MMA a part of exempt list or is it not?
No, MMA is not part of exempt list.
And is it used for re-exports or tariff will be applicable on this?
No, our current understanding is tariff will be applicable on this.
Okay. And secondly, as regards MPDA, we have seen, have we seen any benefit coming in Q4 because of maybe pre-buying, or we'll see that largely in Q1? And also say in terms of FY26, will Q1 we'll see higher volumes, and maybe say once tariffs taper off, will we see rollback in Q2 because we have significant capacities compared to the utilization right now? So I was just trying to gauge the benefit of this MPDA product.
No, so I think the tariff announcements only came in April first week. So in that context, we saw upside, or we're seeing upside as we speak from this quarter standpoint. How does it stabilize in the mid to long term will depend on sort of how the tariff situation finally settles down. But yes, from a Q1 point of view on this specific molecule, we do see some upside.
Understood. Thanks. That's all from my side.
Thank you. Ladies and gentlemen, we will take this as the last question for the day. I would now like to hand the conference over to the management for the closing comments.
So thank you everyone for taking out time late evening. As we mentioned earlier, I think despite a challenging year, we ended a year, I would say, on a positive note with a year-on-year growth both on revenue as well as on EBITDA. As we get into FY26, despite volatile macros, we remain quite focused on driving all the cost improvement initiatives, remain very agile in our business operations to ensure that we take opportunities wherever available, given the geopolitical uncertainty. And in that context, remain committed to deliver on our 3-year guidance. Thank you everyone and have a good night.
Thank you, sir. On behalf of Aarti Industries, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines.